All right, welcome everybody to another Learn It Live webinar with Pepperstone. Today we'll be talking about technically trading the US election. This is one of the three-part series. It's the second week now. We'll be joining you talking about all things to do with the US election, but specifically from a technical analysis perspective. There's a lot to cover in today's webinar. We hope you enjoy it very much. And I think, look, Tyrone is joining me tonight from FX Evolution as well. Ty, it's been a very interesting week, hasn't it? Specifically on what our topic is going to be focusing on tonight, gold, silver, and commodities in general.
Yeah, it certainly is. Hello, everyone. And yeah, look, it's going to be an interesting lead up now. Look, we're only a few weeks away from the big day, and yeah, we've certainly had some ups and downs in the market. But look, gold and silver in particular are really starting to set themselves up nicely for what would be obviously one of the biggest events in the next 4 years, really. So yeah, it's going to be a very interesting lead up, and yeah, it's going to be good to jump in and look at some of the ways we can trade these two of the most popular commodities.
So in today's video, we'll be covering quite a few things in this webinar. We're going to be covering some stuff to do with, of course, the live markets. We're going to be having a look at gold, silver, the different cross pairs right now. We might even be taking a look into some other new forms of gold, maybe Bitcoin and copper. And we'll be talking about what and how things trade, the seasonalities in some ways, the rotations that go on, all of those types of things that happen leading into these types of events such as the US election. And on top of that, we'll be looking at key indicators that we use on MetaTrader 5 and what we're kind of looking for when we're trading these. We're talking about scalping strategies and just in general day trading and swing trading strategies to take advantage, I guess, of these types of moves. We'll have a look at some patterns there as well. And then, of course, our live Q&A. So if you have questions throughout this webinar, why not ask them? We'll answer them throughout the webinar. And of course, we look forward to answering those as much as possible. So Tyrone, I think leading into today, what are we looking at? We've always got lead indicators for market sentiment. We've got the volatility index or VIX. We've got the copper price potentially after recession and into recovery, a very key commodity that's used all the time. Many people call it Dr. Copper. We've got the US dollar, which goes into a lot of analysis that we want to do when we're looking at silver and gold. And then we could have potentially some forms of well-known hedges against uncertainty. Often people consider silver and gold hedges against uncertainty. I did want to just say before, of course, tonight's webinar, this webinar is, of course, general in nature and should not be construed of any kind of financial advice or, of course, solicitation to buy or sell any particular share, commodity, or Forex currency, but instead it's more of an educational tool to help you out. So lead indicators are what we're looking for. We want to know what the market's telling us. What is the sentiment that we're getting from the market in general? And one of the ways we can do that is we can also select the types of things that we want to focus on. We want to focus on gold, oil, silver, and copper. These specific things can show us sentiments about other markets and also give us trading opportunities. And specifically gold and silver are heavily traded by many of you out there. Ty, how often do you hear of people starting off in gold? A lot of people get the gold bug, don't they?
Yeah, they certainly do. And I think it's because it's getting so popular now that the gold price is almost as well known as the price of the Dow Jones at the moment. Like, it seems to be one of those things where people are anticipating the uncertainty that comes along with a very volatile time. We've had the pandemic, obviously. It's been one of those crazy years, 2020. And of course, everybody flocks to gold as a bit of a safe haven. But I think traders have identified it as a potential opportunity to scalp, I guess, the gold price. And I think it's effectively worked out very, very well this year. It's been very, very technical from a lot of aspects, all the way really from the lows of the year up until the 1900s. So it has been, it certainly fulfilled everybody's expectation on the movements that it's done. And I think that's why it's so popular. I think people are expecting that the volatility is going to play havoc with the gold price, and it certainly hasn't let them down.
Yeah, it certainly hasn't let them down. We've had some massive moves in gold and silver. We actually have a chart on how much gold and silver have moved this year, and we're going to be talking about that in just a minute. But I want to begin by just talking about copper and why it's very important to understand copper as a commodity. So we're talking about commodities leading into the election. We're talking about leading out of the election, whether the Democrats or the Republicans win. What will technically copper be telling us? Well, copper is always a base metal, and it's very versatile application across heavy industry, transport, communication, and utilities. In the last 30 years, the growth rate of copper globally was negative only in 5 years, and the economic slowdown was present in 4 of those years and 4 of those 5 years. So it shows you that copper really gives us an incredibly good indication of if it's going negative, there is a slowdown in the economy. And of course, a slowdown in copper consumption can show a global slowdown in growth and weakening economy. So if we have a look at copper when we're talking about it versus something like the S&P 500, it very clearly shows us over a longer period of time that there is a recovery phase. So what happens is copper, which we have here in the red, and the S&P 500, which we have in the blue, if we're looking at this from a technical chart, what we're seeing is during the global financial crisis, obviously both fell in unison. But what's interesting is that the power and the strength of copper out of that subsequent year-long rallies that happened after the 2009 lows was very, very aggressive. And then copper started reducing. It started becoming less of a good investment. It wasn't up so much. Now, why is that? Because of demand from governments, Ty. It's one of those things where when we are coming out of a recession, many governments will build or create construction projects, all these types of things, and that leads on to copper consumption. And here we can see why people call it Dr. Copper. It came off with the market, but then they both recovered very similarly. And the importance here is copper, and we'll see this with silver a little bit later, outpaces the actual market growth. It actually does better than the market, and it does so for a couple of years, and then something very interesting happens. It starts to be a worse investment than the market, than the S&P 500 in this case. And that's a very, very interesting phenomenon. Now, if we look at copper this year, here again, we have copper in red and we have the S&P 500 in blue. And when we transpose them over the top of each other, it becomes very clear that when the S&P 500 was falling, copper did as well. And now copper is starting to out-track the performance here of the S&P 500. It shows that we're clearly in the recovery phase. Now, what did we see in that previous slide? We saw that copper recovered for quite a few years because it was still demanded. Here we have a very strong market, but there may be more left in copper over the longer macro look at these things. So this is something that becomes very, very important when you're also trading silver and gold, and we'll talk about that. So trading copper, not so much necessarily important, but understanding how it moves, very, very important. That means we also want to understand when we want to trade these currencies and whether, or these commodities, and when we trade them, what times are they open? So when you trade Forex, it's generally 24/5. It's generally open all of the time of the day. You can place trades, and of course you can enter and exit. Now, sometimes with commodities, they have closing periods. So these are some of the closing periods here, but if you go on Pepperstone's website and you search gold, copper, closing open times, what you'll notice is that they have the times on the website, and that's always updated to a certain period of GMT, and then you can work out if it's closed. It's a very important fact, isn't it, Ty? Sometimes things can stop and then they all of a sudden open at a little bit different price.
Yeah, and the gaps can be a little bit disconcerting to some traders. So it certainly is worth understanding where the gaps are and really understanding those times, because it does make a difference. And you know, it allows you to prepare. Like you need to be able to, you know, work out whether you want to hold your trades over that closing period, because sometimes some people want to be in only when the market is actually open. So you really need to familiarize yourself with the instrument that you're trading, and just make sure that you do know the open and close time, so you understand if price does something a little bit funky around those levels, that you know how to deal with it.
So links with gold, silver, and oil and trading volatility. So we've been talking about copper. That's more of a thing that we look at for a full-time recovery out of a potential recession or crisis period. But what about gold, silver, and oil out of volatility? We're coming into a volatile time. How will gold, silver, and oil react around this period? So we know how it reacted potentially in the GFC, the global financial crisis. What happened to gold? What happened to oil? And what happened to, of course, the VIX? Well, we know the VIX, or volatility index, that often spikes. We've got a very high VIX right now when we're trading the markets. The VIX is above 20 and has been consistently above 20 And that means that we have a certain level of fear and large moves are possible. We of course know that generally the VIX spikes when the S&P 500 falls or is kind of slowly moving down. That's the usual idea. But right now we have a relatively high market coming into the US election. We have a spike in the VIX, but we also have a very large starting to move on gold and oil. It's been very volatile in the last couple of weeks. And this is because of politics and things around the world. But when we go into the technicals, it'll make even more sense. So the reason I bring that up is because, again, we are in a crisis period. We saw before that copper outperformed during a period of time after a crisis period. Look at gold versus silver. Here we have a gold versus silver 1-year chart. And you can see here that silver fell much more sharply in the period of the crisis than gold did. And this is because gold has certain properties of hedging. And Tyrone alluded to this before. People are interested in getting into gold to hedge against market uncertainty. It's often considered that silver does the same thing, but actually silver is very similar to that copper chart. And that's why I brought it up. Silver is a used metal. It's also used in a whole bunch of industrial builds and all of those types of things. It falls sharper, but it often gives better returns. And if we take a look at what's happened during silver over this period, we can see that silver had a 38% increase this last year versus gold, which was 27.58. So a little bit different there and sometimes a little bit surprising. If we take a 20-year chart for gold versus silver, again, out of the GFC, out of the recession period, we saw silver really get knocked around and then come back incredibly strong for a couple of years, very similar to copper, and then decline off. So there's really a time period where these particular commodities become very interesting to trade. And I think we're in that time period right now. Would you agree with that, Ty? Ty may be having a couple of audio difficulties there, but
in terms of uncertainty, definitely in that period right now. And look, and it stands to reason that, realistically, as much as we're not having a financial crisis as we did in the GFC, there is a crisis of sorts in terms of what the world is doing regarding the recovery of what the COVID-19 has done. Now, we're talking about shutdowns that are about to potentially happen again in the UK. Some of the other world economies are looking at shutting down again. So it's still very, very uncertain. And I think in a lot of ways, this one's actually probably more uncertain than the GFC was, because with the GFC, they could actually find their way out of it. At the end of the day, they started to print more money, and they knew eventually they would print enough money to get the economy back on track. But the problem with this particular crisis is that until a vaccine is basically produced and is effective, we don't know how long this crisis will last. And human intervention can't actually fix this one. Just with the financial crisis, at some point you print enough money and it'll fix everything to an extent. But money can't actually fix this one. So the uncertainty is certainly there, and it's no surprise to see these two commodities really playing the game, because we are in terms of crisis mode in a very uncertain place with a very uncertain future.
But would you agree, Ty, as well, that the governments around the world will be looking for infrastructure builds? They'll be looking for that kind of thing moving forward, especially if after we see the US election play out. I think we both agree that there's going to be a lot of money spent by the US on getting people employed again. Would you agree with that?
They have to, and that's all. That's a certainty, and that's a good thing. I mean, and the thing is, it's not just the US. I think the whole world, all the world economies, all the major ones have to actually do the same thing. We're seeing the same thing in Australia here. The infrastructure projects are starting to really ramp up. They're starting to get a lot of plans for the next few years. So, in a sense of, I guess, correcting this big slump, they have to actually, either print more money or find more money from somewhere to spend the money. And that, of course, is going to spike silver and copper in particular, like you mentioned. And silver is a very used commodity, not like gold, where a precious metal like gold is obviously not going to be used to facilitate infrastructure projects, but silver certainly is. So the volatility is certainly justified, and we can be certain that it's been promised actually by all world governments that the stimulus that they're going to provide to infrastructure in the future, in the coming years, is going to be very, very large.
And I think when you consider that and you see where silver is right now in comparison to its highs back here in 2011, it's very far away. You know, this is a very different market. We don't have those excessive spikes. Now, this was obviously euphoric bubble-like kind of territory, but gold has made basically, well, we know a new high, where at the same time, silver hasn't even come out yet. So silver is kind of like the one that you play with if you want to go with more volatility. Gold is, of course, the safer, slower kind of mover, and they do symbolize slightly different things. I thought it would also be worthwhile showing you all of the different commodities performances over the last year. So the way that they've tracked each other. Again, silver's at the top, gold's second, then we've got copper, so all of the major things that we do expect to do well. Then we've got aluminium or aluminum, depending on where you are. And then, of course, we also have steel and then coal. Now, coal, for several reasons, is getting battered around. But this specific thing is just showing us again that silver is outperforming and copper is doing quite well. So we are clearly in some kind of recovery here. And it allows us to think, well, there could be even more in it for the next couple of years based on previous knowledge of how much these spiked. Again, this is just an idea of the last 12 months in terms of silver, gold, copper, all of those performances. Again, standout performances there from those when compared to other commodities like coal. So we talk about this quite a lot, Ty, but one of the things when we go into technicals, and we're going to get into the charts in just a minute, we want to recognize trends as much as possible. The whole last 10 minutes that we'd really talked about, last 10, 15, was understanding a general consensus on what could happen after we see the US election, after we see some kind of certainty come into spending in the economies. Generally, we see an increase in prices on certain metals, and that creates demand, of course, due to government intervention in trying to create unemployment or trying to create employment instead of having high unemployment. When we therefore recognize trends using price action, we might have a slightly stronger bias towards that direction, and that could help us. It's getting these ideas and getting confidence in trading that's so important. We talk about all the time, having a plan, having confidence in your trade, and obviously following trend whenever possible or following the price action is really key. So we could either be looking at movement up or movement down, but what we do want to do is understand the price action and the way that it's moving. Usually a series of peaks and higher troughs is preferred, and this is a standard kind of market that we want to be looking at for the long side. Obviously patterns as well, double tops, double bottoms, very important to understand. How do things look like in an uptrend? If we're looking at uptrending markets, these are some of the most common patterns that we like to use. We'll probably post in the room right now or in a few minutes a free cheat sheet that has some of our favorite patterns on it that you can get for free access. And obviously, if you want to learn more about double bottoms, ascending triangles, triangles in general, it's a very good place to have a look at, and just to have that maybe on your wall or just even on your computer screen so you can use it as a bit of a cheat sheet when you're analyzing the charts. So these could be 5-minute charts, they could be 1-hour charts, they could be daily charts. These are some of the key patterns that you'll be looking at throughout your process of looking at gold and silver and other commodities moving forward. Now, I've also added on symmetrical triangle today, and I brought this on because we've actually just seen one in the markets, and we've seen one on maybe not gold specifically, but the new form of gold being Bitcoin. So Bitcoin's actually had a beautiful symmetrical on it, and I'm actually going to show you that right now just to show what's been happening in the markets recently and the type of setups and how you can possibly look at scalping those setups within the trade themselves. It's a bit of a unique approach to how we look at the markets. So let's jump into that right now. We're going to actually have a look at this previous Bitcoin price. So here we've got a price, and we can see that price was becoming trapped. I think we spoke about it possibly even last week. Basically, we had a market getting trapped between a top up here, and we had a market being trapped beneath a low. And I think if you look at the daily, it becomes even more clear that this was clearly a symmetrical triangle. We had markets being trapped, the wicks were coming through, but no bodies. And then we had the body close out here, and this was the signal. It's pretty clear also when you look at the chart that we've been in a fairly sustained uptrend in Bitcoin. Now this could be gold, this could be copper, this could be silver. It really doesn't matter. It's the same type of pattern. So we see it here. We can zoom it in. We have the close candle here, and that gives us the opportunity to get a bias. And when we have a bias, we can then go down to the smaller time frames and look for buying opportunities. But a pattern like this also gives us a take profit distance, which is going to be around 2/3. So we can take that 2/3 distance, extrapolate that out from the break, and you can see how accurate that's been to the recent high levels. So again, just the beauty of it is you're given a direction, you're given an idea of where it should go to, and then you can go into the smaller time frames and possibly use indicators and other things to get into there. So one thing that instantly I think about is breakouts here, Ty, going down onto a 15-minute time frame and having a look at breakouts into the direction of trend. Now we already know it should go up here, and we've got strong resistance through 3 touches, and then we have a clear close breakout. Could that be a scalping opportunity for us? I would say yes, it could.
Yeah, and I think and that's the thing that people probably really miss about the commodities that we're talking about tonight, because a lot of the questions we get asked on a weekly basis is, how do we trade it? And okay, we do want to trade gold or silver, or even copper for that matter. How do we trade it? Well, the simple answer is you trade it exactly like you trade currency pairs, because the technicals actually stand up in a very, very similar manner. And I guess the one thing about technical analysis, which I'm sure a lot of you who have been here for a while know, is it's all very repetitive. That it doesn't, it brings up the same signals all the time, no matter what you're looking at. And the beauty of looking at charts is it really doesn't matter whether it is actually Bitcoin or gold or silver that you're looking at. The technical patterns are the technical patterns, and yes, you do get your breakouts and you get your little technical setups to scalp, or you can take longer term positions. And this triangle break is a perfect example of how effective they can be when you see them. And then not only the break itself, but when you do go to those smaller time frames, seeing how many opportunities you actually get to get back into that trend if you missed the initial break. They're a very, very technical setup. And the more that they become readily tradable by the big, vast majority of people, the more the technicals are going to make sense.
Exactly, Ty. And I was just pointing there to a 20 exponential moving average on the 1 hour. So every time it came down to that throughout this, and obviously there's a bit of a gap here because of the weekend trading on this particular one, but we did see buying potential. The 20 is a great moving average to have in your chart. Whether you're a 5-minute or 1-minute trader, it doesn't really matter. It's a very good exponential moving average to have on the chart. So Ty, when we're bringing it all together and we're thinking, well, what's going on right now? Well, we want to be looking obviously at copper. It's a great idea of whether we're seeing recovery in general other markets. It's something that we can use as a tool. We absolutely can use it as a tool. But we can also use the US dollar as a tool. And the US dollar index is available on the Pepperstone platform. And it gives us a really good idea of being able to look for support resistance and other kind of key sentiment readings, and therefore then go over to gold and silver and have a look at those. So here we saw yesterday, let's go to a daily here on US dollar. And we obviously had an incredibly large bullish candle coming through. It was a very large bullish candle. Now, we know that that is going to affect our trades on things like gold. I mean, obviously gold is not going to do necessarily very well versus the US dollar when it comes to US dollar strength, and therefore gold may weaken against that US dollar strength. But a lot of things synergize together. We hit a 93.50 on that US dollar index, and at the same time, we've hit this little trend line here on gold. So you'll notice here on the 4 hour, we've got a little trend line through the wicks. We got through, but we didn't break below on this 4 hour. And then we've actually bulled off that zone. So this is obviously a very key important area. And it makes sense that this zone would be held. It gives us a lot of synergies with that. At the same point as gold versus US dollar is hitting this literal trend line, then we're probably going to have something like silver hitting a key area of support resistance. And it certainly did. It came down to our previous kind of range of resistances, slightly got through that, and now it's starting to test the bottom of that from a resistance perspective. So generally speaking, understanding what happens on the US dollar will help us trade gold versus US dollar and silver versus US dollar. But remember, Pepperstone has a whole bunch of other platforms. They've got gold versus euro. gold versus Great British Pound, gold versus Aussie dollar. Notice how each one of these looks slightly different. Here's gold versus US dollar on the 4 hour. If we have a look at a 4 hour gold versus odd, it looks totally different, Ty. It looks more like it's in a trading range. And even though we're still trading gold, we have a completely different scenario on this chart. And that's why I think it's really interesting time, especially if you've got a Pepperstone platform, to be able to log in there and have a look at the different cross pairs if you haven't done so before. If you've only looked at gold US dollar, maybe it's time that you consider looking at gold odd, gold pound, gold euro. We've seen some amazing trades on those when maybe gold US dollar hasn't been presenting. I mean, what are your thoughts on that one, Ty? I mean, it's been happening so much this year.
Yeah, it definitely does. And it's a little bit like the currencies. I mean, when you're trading currencies all the time, you're not always going to get a good setup on some of the ones that you may look at. But I think what this webinar is probably highlighting really is that even if you are trading commodities, it's not just trading, gold, silver, and maybe copper or oil. Like, you've got it's almost like a cross pair, if you like, where you've got the euro gold, you've got the pound gold, and all of them are painting a very different picture. Like, gold might still be strong, but you've got to remember that the currencies that are being based against are very, very different, and they are moving in very different directions at the moment. So it's vitally important to check out all of them, because the best trading opportunity may not be where you think it's going to be. And as a trading rule with all trading, you want to trade the best looking opportunity. That's you always want to be taking the trade that looks the cleanest and the one that is setting up the best, not necessarily the one that you want to trade. So it's very, very important to check them all out, because sometimes, like Thomas said, the opportunities that have been present this year in pairs that you may not have even looked at would probably really surprise you.
So here's an example of, I guess, gold versus Great British Pound. It's kind of trapped within a bit of a range recently in price. Now, Great British Pound's been incredibly volatile, but because of the nature of the cross pairs here, this one's actually become quite trapped. And there it gives you opportunities to potentially look for buys and sells off the key resistance and key support zones. So obviously there's some kind of 14.55 support here, multiple supports. We can go down to 15-minute, 5-minute charts, look for opportunities on those timeframes for maybe the buys and the sells, because we are in a channel pattern there. Then if it breaks out to either side on the larger timeframes, we can always take the distance of that range, just like any good channel tie, and then extrapolate that out and aim for that as a target. And then just like the symmetrical triangle, again, we get a bias, go down to the smaller time frames and start looking for opportunities in that direction until it reaches the kind of fulfilling prophecy of the pattern. So it's these understanding that there's multiple different ways to trade gold. Sometimes gold doesn't look good, but maybe gold pound, gold euro gives you the scalping opportunity that you want. And there certainly is quite a lot of different opportunities, I think, right now in the cross pairs. I think gold is tough because of the US dollar index moves, but maybe gold euro, gold pound, gold odd, not as tough. If we have a look at the way silver's been trading as well, on a bigger time frame, if you're not looking at these as a scalper, it is worthwhile considering that. There's no coincidence that silver dumped off and it moved down, but at the same time, it found some form of support around that 20 exponential moving average on the weekly. Remember, we said the 20 is very, very important moving average zone. Even in silver's run up here on the daily, when it did eventually come back and touch it, it found support there, it hovered around there. And notice when it got through that zone, that was the beginning of a further large sell-off. So the 20 exponential moving average, if you were just to put one moving average on the chart, Tyron and I would always say 20. I don't think there'd be even a question about that, Ty. Always the 20, yeah?
Is the one, and you've seen it in every example that we've put up here. The red line is the 20 exponential moving average, and you can just see how many times price actually interacts with that level. No matter what you're looking at, no matter what time frame you're on, it's the one moving average that you must have on your charts, and it's the one that we would swear by. If we were any one indicator, that would be the one.
Yeah, it certainly would be only one. It's just there's no way that we could probably go with any other one. It's just it works so well through commodities, through forex, through stocks, through indices, through everything. It's just a great kind of moving average. So let's go back into the slides now, Ty, and then we'll revisit the charts in just a little bit. But basically, I want to talk about the way that we can potentially approach into this election. So we've talked about so far, just to recap, we've got copper potentially in recovery phase. We've got silver potentially in recovery phase. We saw them performing very well over specifically the last kind of 6 months after this crisis. They're clearly in demand. They're used in infrastructure builds. They're used no matter whether the Republicans or the Democrats win, there will be builds that will use those particular metals. Now, how do we then approach a perspective of finding opportunities? Well, one of the best ways, whether you're a 5-minute scalper, 15-minute trader, swing trader, day trader, is always going to be role reversal. And we talk about this all the time, basically where a certain level of resistance is formed or support, the level is broken and closed above, and then it is tested from the downside. Now, there's another way I like to look at resistances, and this is a bit of a trick that I use a little bit in, I would say, scalping. So what I call it is the 1, 2, 3, and I've mentioned this before quite a few times, but it's quite an efficient little idea. It's the idea that if a market breaks through a zone and closes above, let's call this a 5-minute chart. When it breaks through and closes above, and then it comes back down and it tests this 1, 2, 3 level, because this was such a key level of resistance and multiple times touched, there must have been something important about that. When the market closed above, there was clearly a movement of money, a movement in psychology of the markets. And this will work in gold, it will work in silver, it'll work in any of those things. So when it comes back down, it does that test of the role reversal, and the 1, 2, 3, more than even the 2, basically just presents a very, very strong zone. We know it's there. 1, 2, 3 is always worthwhile. It could be 4, 5, 6, 7, 8, but definitely at least the more touches, the more likelihood that it's going to be a respected area. And that's the importance, isn't it, Ty? We want respect on our areas, and we want to find high statistical chances of being successful. So 3 indicators a scalper can use with something like that 1, 2, 3. Well, we talked before about what we were seeing with gold and pound. We saw stochastic. We saw a market that was trapped. Now we could use stochastic, we could use MACD in range-bound markets, and of course in moving average markets, we don't want to use these in any kind of range-bound market. So in range-bound markets, we don't want to use moving averages, but in trending markets, we do. And that's something that a lot of people use. They sometimes say, okay, we're going to use moving averages in a range-bound market. The problem with that is that often when they're range-bound, the bigger time frames, they'll be just crossing each other, crisscrossing, giving us a lot of fake signals. Now, if you're in a channel on a 4-hour and you're trading a 5-minute chart and we're trading off resistance and we see a cross, that cross is going to be okay, but we need to understand that we're still trapped within a range on the higher time frames. We've obviously got to take profit always at the bottom of the channel. If we're using the moving averages in that trade, so we maybe look for stochastic overbought up here, we look for MACD divergence between the previous kind of peak where it touched the resistance last time, and then we look for a cross to give us that entry signal, that's fine. We can use it there, but what we don't want to be using is crossing or moving averages as dynamic support or resistance when we're stuck in what we know is a price action channel. So you always want to be aware of that. So stochastic and MACD are great indicators along with RSI for trading within those ranges. If we think about stochastic from a standard perspective, we've used this slide a few times before. Obviously, overbought and oversold is the traditional way people do it. We basically go into the overbought area, we look at sells, we go into the oversold area, we look at buys. And we can use this just like a channel. Think of this as a channeling market. And if the market goes down to the bottom and we see the signal, and of course, both the slow and the fast line crossing each other the way up, that is a signal for us to potentially enter the trade. But we must use the price action first, whether it's a 5-minute or 15-minute time frame. It's very, very important. Again, works on gold, works on Forex, will work on anything. Stochastics is another way of also trading within this range here. And we can see that this is an up market. Now, I've got this as an example, but if we're in a market that's going up, we don't want to be selling against the trend. I know a lot of people do it, but these are the dangerous kind of periods. If the market is up and we're selling in the overbought zones, it can be staying in the overbought zone a very, very long time. So what you prefer to do is use a mixture of role reversal and other reasons, and therefore use more of the oversold and look for buys with candlestick patterns, with role reversal, with other ideas, not just stochastic by itself. So I prefer stochastic in a range bound market, similar to what we were seeing in those commodities before.
It's really important to understand the market that you're in. So when you know you're in a sideways market, yeah, you can trade both sides of the stochastic. But when you know the market is trending, to only use it in your favor, because I think it's really, really important. Because otherwise, like you said earlier, you can definitely come unstuck if you're trading only in the one direction and trying to short on an oversold in an uptrend. That's for sure. You've got to understand which market you're in.
Yeah, exactly, Ty. We need to understand the market conditions that we're in. So we spoke about before how we have multiple different golds and silvers right now, and silver does have a bunch of different crosses on the Pepperstone platform as well. So gold is clearly testing this trend line here on gold US dollar. When we're doing this analysis, we're going to need the US dollar index. We can see the US dollar index is strengthening right now. We have a clear level of resistance here at the 93.90 zone. If it was to move to that other area, do we think gold's going to be getting through this trend line? We certainly do. And then what we need to do is we need to start drawing up our higher time frame support resistances. What will happen in a market is as we go through key zones, so we go through, let's say, this support and we break and close through 1876, the market will have a tendency to then move to the next area. And a lot of scalpers lose sight of what we call a top-down approach. And that is that when these levels are broken and closed below, the market will gravitate to the next area. It will gravitate to this 1850. And what we don't want to do is fight against that. We would rather go with the trend, look for the sell signals on the smaller time frames. Again, they could be candlesticks, they could be overbought stochastic on the way down. It could be all sorts of things when we're going through, but this will be the fill area. So 4 hours are really great for commodities trading to be able to get a sense of direction of key support and key resistance on these charts. It's very, very key that we look at those kinds of things. We've got some questions coming in here, Ty, and one of them is about whether we do get replays for this. Absolutely. So the replay will be on YouTube. It'll be on Pepperstone's YouTube, so you can go and subscribe to that. And I guess at the same time, you can also have a look at FX Evolution's YouTube and check that out as well if you're interested. But you can definitely get all of those things. So understanding the 4 hour swing here, commodities trade just like Forex very, very well off the 4 hour charts. We specifically like to look at the swing trade from a support resistance level, and then we break it down to the smaller charts. Similar to what we saw in Bitcoin, same kind of thing. So that's the kind of way that we're looking at it right now. If we were looking at maybe gold odd, we're trading in a range. If we're looking at gold pound, looking at a range. If we're looking at gold versus euro, it's a little bit different. It's not necessarily the same thing. We noticed it was trading in a range, it broke out and closed below, and now it's trading in kind of a new, more of an angled range here. So we'd probably be drawing a trend line through the bottom, and we'd also have this strong resistance up here, and we'd be looking at trades in between those zones. That's the way we'd be looking at it right now. So into the US election, what do we expect to see as well is basically an increase in volatility on these pairs. We're going to see the VIX basically increase into the day. During the 2016 election, I still remember it very well, almost every single trading instrument on earth was going ballistic both ways during the futures trading sessions. We had massive moves on gold, massive moves on silver, massive moves on the markets around the world, and everything reversed very quickly. In fact, I think within the space of around 10 hours, we went down something like 3 or 4% or maybe 5% on the S&P, and then fully rejected that and ended up high. Ty, you remember that time. It's an exciting day, isn't it?
It certainly is. And yeah, it's not for the faint of heart, and you wouldn't want to be just jumping in your trades because the way they were moving hundreds of pips every second was just incredible. But it's certainly fun to watch, and yeah, really looking forward to this one. Actually, can't wait for it.
Yeah, when we're talking about them moving into this election now, we will be seeing increase in volatility for the next couple of weeks. We obviously are not going to see these debates. The debates would have been catalysts for some movements on the futures markets. It doesn't look like we're going to see those for now. In terms of things like stimulus plans as well, we may not see that either until possibly a new elected party in January. So what we're going to be looking at now is more poll figures, more volatility just with people rebalancing in and out. And I think we want to look towards the future as well. You want to look towards what happened in the past and why we spent 15 minutes at the start of this webinar talking about what happened previously in the GFC coming out of a crisis is because, again, governments have a tendency to do the same thing. They go to what worked in the past, and that was infrastructure, that was buildings. So if we build on that case, we build on the idea of maybe strength there. When you're in longs, whether you're holding longs for a longer period of time, and you're maybe using that more as a swing trade or a longer term investment or something like that, which a lot of people like to do with gold and silver, you might have some confidence in that. We can also have confidence that potentially the Federal Reserve is devaluing the US dollar over a longer period of time due to what many people call it as the printing press. So we'd like some questions in the room right now. Ask your questions and we'll answer them as best we can. And I've got a few coming in. So just ask them now and we'll answer those in question time. I'd also like to just remind everybody that we have an election special on right now, our technical analysis masterclass, which goes through role reversal, price action, all the indicators we use, exactly how we use them, and literally all the stop loss kind of areas where you want to place all those types of things is on sale for right now running into the election. We're doing 25% off. The coupon code is election25. And you also get 3 months access to our private trading chat room where we talk about, of course, all the different currencies, all the different commodities and indices around the world, and people share their ideas and, of course, share all of their knowledge with each other, which is great. So we have a couple of questions coming in here. It says here from Jai, hi both. I have less confidence in identifying the direction via the high time frames and hence rely a lot on the moving averages to tell me the direction. But the occurrences of the direction go against what I have thought are quite often maybe the right way. Any advice on this? So I won't give you any advice because I can't do that. It's obviously general in nature. But what I will say is that what you generally think is going to happen and what is happening is often misconstrued. You know, there's a lot of talk right now about fake media and all those types of things. But remember that people always have opinions. They write opinion pieces and they stick in your mind and possibly influence your technical trades. When you're getting influenced by technical, by fundamental information, it clouds your judgment on what you're doing on the technical timeframes. If you're looking at an opinion piece and then trading a 5-minute chart or a 1-minute chart, the opinion piece wouldn't be relevant anyway to that time frame. It just wouldn't be. And therefore, what you should really be looking at doing is instead focusing on the price action, focusing on the larger time frame support resistance breaks, and focusing on the movement to the next direction or the next move. Once you do that, again, even if you're a scalper, you'll find most professional traders, that's the thing they do. They focus on the price action and try to leave their personality or their ideas or their opinions at the door. They focus on just what the market's telling them. Makes it a lot easier. If you're having problems, you can always run a demo account, get a Pepperstone demo account and run that next to your live account and just leave it in. If the trade said go this direction and that's what your system's telling you, you could leave the demo in and then compare them both. Which ones does better? Are you your own worst enemy? That's definitely a question that gets asked. Quite a lot of people asking for replays, definitely on Pepperstone's YouTube channel. You can check that out. A question here from Warwick, is there a direct correlation between gold and their currency? Yes, so there is some correlation there. We saw that with gold versus Great British Pound, Warwick. We've got obviously gold declining against the US dollar, but at the same time, we also have the Great British Pound currently declining against the US dollar. So when you've got both of them doing that, what does it create? A sideways market, hence why it's trapped right now in a range. For Duke says, how would you trade news releases around the elections? I think trading news releases is pretty dangerous. I mean, some people try to trap the price and they try to trap the range, I think that's a little bit dangerous to be doing. What you probably want to do instead of that is you'll notice that before a key bit of news release, generally a market like gold or silver or anything will go towards a resistance or a support on the larger time frame. So look at your hour, 4 hour, and daily. Once those levels are reached, if the market then breaks out after that key bit of news, often what it will do is it will trace back. So let's say we had something like I said before, the 1, 2, 3. It's coming up towards the release and it breaks and closes above that zone. Often it will come back down, test that previous resistance as support after it's initially got that kind of exuberance, and then that becomes the next flow on effect. So one of the things I like to do is I like to see whether the market is coming into a key resistance or support before the news. If it is, I let the news break it, and then I make a judgment call and decision based on the technical charts. All right, well, we thank you very much for attending tonight's session, of course, on gold, silver, and other commodities around the world. We definitely encourage some of the things like going and having a look at the other cross pairs of gold and silver. We encourage you to think about it from a bigger perspective, and of course, bringing down the top-down approach through with all those patterns. We are running another webinar right after this where we go into the live charts, we go into currency charts, and we talk about all of the current market happenings. If you're interested in attending that, you certainly can. We should be placing a link in the rooms in just a few minutes. I'll actually grab one of those, and we hope to see you there. Otherwise, we'd hope to see you next week in participation, of course, before the US election itself. So happy trading, everybody out there, and we'll see you next time.
And don't forget, there is a survey after this webinar, so if you could just pop your answers in there, that'd be great, because it helps us get the next webinars in the future tailored to what you're all after and what you want to see in these webinars. So thanks again for joining us. Yeah, please do the survey at the end, because it does make everybody's job a hell of a lot easier to produce the best quality outcomes for you. And we hope to see you either in the next 15 minutes or next week.
Absolutely, Ty. Yeah, we hope to see you then. Bye for now.